Welcome to Income, Cash, and Balances, part of the MyCloud MBA resource series. This video expands on concepts introduced in our prior videos, understanding revenue and understanding margins, and explains the importance of the income statement, the cash flow statement, and the balance sheet. As previously explained, gross revenue is the accumulation of sales over a given period of time, and net income is what remains after cost, expenses, and taxes. Under cash accounting rules, net income generally equates to the money an owner can take home as pay or distribute to shareholders. Most businesses, however, are not entirely cash-based and accrue considerable non-cash assets, such as equipment and inventory, as well as liabilities, such as tax obligations. Extending payment terms to customers also creates income without receiving actual cash. As a business can be technically profitable yet fail for want of cash, knowing actual cash versus income or liquidity is critical to running your business. Operations generate the majority of cash and include customer receipts less cash used to pay current costs and expenses. Purchasing investment reduces cash, but selling business equipment increases cash. Finally, cash is generated from financing activities, such as bank loans or selling stock to investors. While cash flow analysis uses many of the same terms as income analysis, they often refer to different financial transactions. If a business sells $100,000 of custom wheels during May and incurs $50,000 in direct production cost and an additional $20,000 in fixed shop operating expenses, income from operations is $30,000. Furthermore, if customers paid cash for their purchases, and similarly, the business paid cash to their vendors, net cash from operations for the month would increase by $30,000. If the customer was extended 90-day payment terms instead of paying cash, income remains at $30,000, but cash becomes a negative $70,000. Everything should even out when the customer pays later in August. But in the meantime, the business needs $70,000 in cash, or else the liquidity problem could shutter the doors. In spite of no cash, income has been created, so the government still wants its taxes, calculated at $1,000. But the tax payment is not due until the end of the quarter, so no cash is dispersed in May, and instead, taxes accrued as an expense of $1,000. Income is now reduced to $29,000, while the cash position remains unchanged. Dipping into its line of credit by $75,000, the business partially finances the customer purchase to keep the shop door open. Income remains unchanged, but the line of credit is entered as a cash inflow of $75,000 for a net cash position of $5,000. As borrowed money, the bank charges $1,000 in interest on the line of credit, thereby reducing income to $28,000 and net cash from operations to a negative $71,000. Adding the $75,000 from the bank loan to the negative $71,000 from operations, the net cash flow for the month of May is now a positive $4,000. To raise cash, the business sells an old piece of unused equipment for an immediate $5,000. As the cash received is not part of regular operations, it's noted as an investment, and income is now $33,000 and net cash is $9,000. In some future month, when the customer actually pays cash for the purchased wheels, an entry will be made into the cash ledger while income will remain unchanged. With a demonstrable difference between cash and income, 3 reports are required to manage the financial health of the business. The income statement tracks how much a business earns over a period of time, such as a month or a year, and reports revenues less costs and expenses. The cash flow statement tracks the movement of cash through a business over the same period of time and reports net cash from operations, financing, and investments. In contrast to the first 2 statements, the balance sheet is a snapshot in time and reports on assets owned, liabilities owed, and the equity difference between the two. Depending on the preparer, financial report formats may differ, but still contain similar elements. Transcribing data from the previous worksheet, the income statement shows revenue, cost of goods sold, operating expenses, operating income, and net income. The primary difference between the worksheet and the income statement is the inclusion of detail and percentage of revenue columns. It also identifies the reporting period, May 1st through May 31st. Data from the worksheet next creates the cash statement with the same reporting period as the income statement. It includes a beginning cash balance of $5,000 for the 1st of May, and adding $9,000 from the worksheet yields a $14,000 cash balance for the end of May. The last business report, the balance sheet, reports financials at a specific point in time. To coincide with the income and cash flow statement, balances from two dates are compared, the last day in April and the last day in May. Calculated from the May cash flow statement, actual cash increased by $9,000, so the first entry in the balance sheet is the short-term cash asset of $5,000, increasing to $14,000. The second current asset, accounts receivable, increased by $100,000, reflecting the wheels sold to the customer but not yet paid. Selling the equipment for $5,000 decreased the long-term asset category of equipment from $50,000 to $45,000. All totaled, assets increased from $65,000 to $169,000 during the month of May. As all vendor purchases during May were paid, accounts payable, a current or short-term liability, remained the same as April at $10,000. The largest increase in liabilities came in short-term loans, reflecting the draw on the line of credit by $75,000. Since the newly estimated tax balance of $1,000 for May was not paid, the current tax liability was increased by another $1,000. Adding all liabilities together, the business went from $36,000 to $114,000 during May. The final set of entries on the balance sheet identifies owner's equity. Owner's equity is a financial construct and does not necessarily indicate the sales value of the business. A true business valuation requires a separate professional analysis. The first entry of $5,000, original investment, did not change during the month of May. Retained earnings is a calculated value and reflects changes in the business's book value. By convention, total assets must always equal equity plus liability, so equity is calculated by subtracting liabilities from assets. For May, we subtract $114,000 from $169,000, leaving $55,000. Since the owner's original investment is included in total equity, we subtract $5,000, leaving $50,000 in retained earnings. Balance sheets may have more entries, such as long-term loans, but any additional entry is still an asset, a liability, or an equity. In summary, income is not the same as cash. A business has three sources of cash: operations, investments, and financing. The three business reports essential to knowing the financial health of your business are the income statement, the cash flow statement, and the balance sheet. Any accounting system should produce these reports, but usefulness depends on timely and accurate data. In a follow-on video, Improving Cash Flow, we'll provide a few common techniques for improving your financial health. The contents of this video are the opinions and property of Expedite. While great care has been taken in its preparation, subscribers are responsible for determining the suitability within their business or personal affairs.